I guess I had a follow-up on the loan platform business as well. Is there a way to kind of frame the number of buyers on the platform and kind of what your next full quarter capacity looks like? And then also talk about the process. I think you mentioned it a second ago, Chris, about how companies upsize their commitments.
Kind of out there at the end, Reggie, but I think you asked about the process for how companies upsize their commitments. In terms of your first question about the number of buyers on the platform and what the next quarter's capacity looks like, we aren't going to disclose the number of buyers that we have. We have disclosed a few publicly with Fortress and Blue Owl, but we have a number of partners on the platform. What capacity looks like next quarter, we did $3.4 billion of originations on behalf of others this past quarter in Q3. We expect that to continue to grow heading into Q4. In terms of how companies upsize their commitments, they typically come to us intra-quarter if they have excess capacity or demand for incremental loans, and if we're able to fulfill by the end of the quarter, we'll do so.
And the behavior we're seeing of consolidation down to higher quality, we're definitely, that you mentioned, we think we're benefiting from that based on the activity we've seen from those partners.
The next question comes from Peter Christiansen from Citigroup. Peter, please go ahead. Your line is open.
Thank you. Good morning. Thanks for the question, and nice trends here for sure. Anthony, I was just wondering, can you remind us where we are in your investment cycle? Perhaps not just like the marketing, performance marketing, branding, those sorts of things, but maybe more so in capabilities. I know you're going to be onboarding some new clients on the tech platform pretty soon, and now building out crypto, whether that's partnered or native. Just if you could frame for us where we are in the investment cycle. Thank you.
Yeah, I would like to invest a lot more than we're investing, but we're trying to balance both growth and being responsible for delivering profitability and good returns. We don't want to go after penniless growth. And so the gating factor that we've put on and talked about publicly is to have at least a 30% incremental EBITDA margin. And I say the word at least because if the business does well relative to expectations, it's hard to spend back in a quarter. We may accelerate some hiring, but that really doesn't impact the near-term quarter. It impacts the next quarter. And we've hired a lot more people in 2025 than we set out at the beginning of the year because we've been driving both strong top-line growth and really strong incremental profitability. I would love to spend every dollar we could down to that 30% incremental EBITDA margin. It's not always possible to do that. That 30% incremental EBITDA margin will be the standard until we see our growth drop below, call it 15%. I think as long as we're growing above that, we should invest in the business to make the top line as large as it can be. And then over time, we can slow down our spending and drive margin expansion. But we're definitely not in the mode of driving margin expansion unless we outperform compared to the 30% incremental EBITDA margin. The areas we're investing in is we'll continue to iterate on our existing products. We're focused every day on 5 things of our existing products: fast selection, content, and convenience, and then make them better together. There's some products that are new that we'll increase the investment in, such as SoFi Plus. We're really pleased with the progress we've made there. There will be additional things that we add into SoFi Plus as it relates to value, one of which is the Smart Card. We think it's the best of any card. It'll have high rewards, 5% on food. It'll also have high interest or highest APY. In addition to that, you can also build your credit score, and you'll be able to use that relationship with us to potentially borrow both ahead of time and post transactions. And that will be an evolving feature set after we launch that will continue based on how we learn our members want to use the product, but focusing on the smart things that they want and making it have the best of everything. We talked about Cash Coach on the call. There's a number of AI initiatives to help people spend less than they make and invest the rest. It is a unique formula that we can deliver on in addition to the investing piece. one of the things that's interesting about our buy, sell, and hold for crypto is that the way we'll launch this product is going to be pretty novel. Someone will open up a SoFi Money account. If they don't have a SoFi Money account, they'll fund that SoFi Money account, and then all their purchases are drawn from that SoFi Money account. What's the benefit of that? Well, that SoFi Money account has FDIC insurance, and we've added additional insurance for our members if they opt in up to $2 million, not just $250,000. So someone can have an FDIC insured bank account where they keep their funds and seamlessly be able to buy cryptocurrency, and the money moves from one entity to the next seamlessly behind the scenes. A very efficient process that I think will be very differentiated and will be the first bank to offer buy, sell, and hold crypto. We've mentioned stablecoin on the call. I can just tell you every day there's a new opportunity for us to leverage the SoFi USD stablecoin that we'll plan to launch, and we have some unique advantages that we're already a tier one bank. What do I mean by that? Because we're a tier one insured deposit institution, we can take the reserves of our stablecoin and put them at the Fed and earn Fed funds. What does that mean? Zero credit risk, zero liquidity risk. There's not a stablecoin provider in the United States that can make that claim. Very differentiated, super excited about it, and there's a number of other applications there. You can imagine that Fed funds that we earn on those reserves, they could be given back to the consumer, they could be given to businesses to accept our payment at point of sale, and it can provide a lot of different benefits to other ecosystem partners that cause them to want to partner with us as opposed to a non-tier one nationally licensed bank. So we're going to invest as much as we can to that 30% incremental EBITDA margin and sustain high levels of growth until it slows down, and then we'll drive profitability.
The next question comes from Moshe Orenbuch from TD Securities. Your line is now open. Please go ahead.
Great, thanks. Maybe a little bit about the competitive dynamic in the personal loan business. Saw one of your close competitors got acquired by a large bank. Do you think that makes the business, kind of a better competitive dynamic if that happens, or maybe just talk about that a little bit? And if you could also just address, you talked about becoming more capital light. How much of that do you think comes out of the personal loan business, in terms of doing less for your balance sheet or proportionally more in the loan platform side?
In terms of competition for PL, I'd say it's generally been a competitive environment, but from entities that are not large national banks or the top 10 banks in our country, they just don't offer this product. I think there's a lot of reasons for why they don't offer this product. It's a gap in their portfolio that allows us to really gain, I think, more members at efficient costs. I think the reason why they probably don't offer the product is because they gouge people so bad on credit cards, and it's such a great ROE product that they don't want to cannibalize the credit card. The way you make money in the credit card business is the revolving balances. Well, credit cards average in the United States over 20% interest on those revolving balances. If you actually had a prime member or super prime member and told them they're going to get charged 20%, they wouldn't sign up for that any day. But if you put that behind a fancy name of the card and all these benefits and high rewards, no one sees the high interest rate that they get, and they chase those reward points thinking they're getting some benefits from it. Then they end up with a balance that they can't pay off after 1 month, and then they said they'll do it after 2 months, and before you know it, it's been 6 months. They now have a $10,000, $15,000 balance. They're paying 20 to 30% interest on it. Would you refinance them with a personal loan at 12%? Probably not. So I think this is a product that we're going to own from a leadership standpoint, and we'll continue to bite away at these huge balances where people are paying over 20% interest when they can come to us and pay 12%. Again, prime and super prime customers.
Yeah, and then what I would say on your point about being capital light and how much of it comes out of the PL business, what I would say is total personal loan originations were up 53% this past quarter, year over year, and 7% sequentially to a record of $7.5 billion. So we don't see much in terms of overall cannibalization, given our current market share, which is about 15% of total unsecured loans. out there within our credit box, and that doesn't even scratch the surface of all of the outstanding credit card debt, as Anthony mentioned. So we're seeing really good momentum on the LPB side, and we're adding loans to the balance sheet at a pace that we are comfortable and happy with. This past quarter, we added about $2.7 billion of personal loans to the balance sheet, which is a good, healthy clip for us.
Our final question today comes from Devin Ryan at Citizens Financial Group. Devin, please go ahead. Your line is open.
Thanks so much. Good morning, everyone. I want to come back to the student loan opportunity. Obviously, you talked about kind of the outlook moving into a better place there with the rate environment. Can you talk a little bit about how you see some of the actions of this administration driving kind of a better environment, whether it's the big, beautiful bill? And then a few weeks ago, there was obviously headlines around the government exploring selling some of its $1.7 trillion in balances, which would seem pretty interesting for you guys. So love to get some thoughts on that. I'm not sure if you can speak to it directly, but just more broadly, if you can, just what you think that means for the market and kind of the direction of travel. Thanks.
Yeah, I think it's all very positive for SoFi. I think we benefit from all of those decisions if they get made. We look at assets from time to time that are for sale. If the government decides to sell their student loan portfolio, we'll absolutely dig into it. It'd be a great customer acquisition tool, not to mention the fact that we can make a significant profit on that portfolio of assets. As it relates to potentially reducing the amount someone can borrow in order to go to college or grad school or business school or medical school, or law school, we'll be there to fill the hole. We want to help our members achieve the financial independence so they can live their ambitions. Paying for college, paying for a home is absolutely a critical decision they make, and we have to be there for all those major decisions they make. So we'll absolutely be there if they need a solution that the federal government is not providing, and that will also be a great business. Our in-school business for loans is a very profitable business. It's very attractive, and doing more of that would be even better than the student loan refinancing. It's at higher rates. It's backed by credit of another person, and people really do want to pay back the benefit that they receive from getting a college education. So that would also be an opportunity. I would say more broadly, as we think about our educational system and think about the changing needs from technology standpoint, AI, there may be new types of loans that we could get into from a student loan perspective that's outside of a 4-year type of experience that's more suited for the professional environment new graduates will enter into. So I think we'll actually see some innovation because of what the government's doing and because of the impact technology is having on hiring undergrads. Great. Thank you, operator.
Back to you.
Thank you, operator. Sorry about that. As you can see, it was an eventful quarter at SoFi, and we are energized as we wrap up 2025 and head into 2026. Today's results reflect the durability of the foundation our team has been tirelessly building over the last 8 years. If it was not clear before today, I think it's safe to say that our results demonstrate that we truly have become a one-stop shop for all your financial needs, all in one digital platform. Many others have talked about achieving this strategy, but to date, no one else has come close to the breadth of products or complexity of operations that we have, not to mention the revenue scale we have, the profitability we're generating, and the durability and broad diversification of revenue across our portfolio of products. This success positions us the best to benefit from the two tech super cycles unfolding and the continued strong sector transition globally from traditional finance companies to fintech companies. Suffice it to say, I'm more confident than ever that our strategy and our execution will continue to deliver our sustainable competitive advantage with the highest lifetime value, and we'll accelerate our investment to ensure we maintain our lead. Along the way, we will remain guided by the SoFi way. We are all operating as founders, problem solvers, and partners to bring the best products and services to our members so we can have a meaningful impact on their lives and lead them to a better, more secure financial future. By acting in the best interest of our members, we will build deeper relationships across our one-stop shop platform that will lead to durable growth and strong returns for our shareholders for decades to come. Thank you for joining our call, and we look forward to talking to you next quarter.
Goodbye.
This concludes today's conference call. You may now disconnect.